Hello, friends. Welcome to the Weekend Investing Daily Bite of 30th of January. We are one day away from the budget now. Markets have come off the bottom, this bottom so far, let's say, and we are in some sort of stable territory right now. Um, the topic that we're going to discuss today is about advice given by others to you. How much of that you should take, and if you are taking that, also take the context of that advice. We'll dig deeper. This is more of a behavioral kind of a topic. How easily we get influenced by others' experience is something that you want to think about. Disclaimer, as always, please do read it fully, carefully, and do subscribe to the channel. Let's look at now what happened to the markets today. Nifty, after closing above a 2-day high yesterday, continued to build on that, lost some ground from the highest point, but still managed 0.37%. I think for now, this is a reasonably good outcome with the kind of panic we saw 4 days and 3 days back. Uh, one would not have imagined that we would recover 4 to 500 points within a matter of 3 days. So this is reasonable in terms of where we would have thought we would be just on Monday. um, Markets have sort of now come back to the higher end of this range, and a breakout above 23,400 will give it more tailwind. But certainly in terms of the longer trend that we are witnessing down, we are nowhere out of it still. Nifty Junior also tried to go up but failed to do that, 0.08%, so closing flat, waiting for the next cue. Mid caps also closing the gap, 0.17% up. Small caps 0.18% down, not yet able to close the gap. So small caps seemingly looking weaker than Nifty Junior and Nifty Mid Cap as well. Bank Nifty, fourth session in the green, 0.3% up. Bank Nifty is now close to this pivotal top. I think once we do break into near 50,000, we should get some more confidence in the banking space. Advance decline almost equal, 230 declines to 268 advances, so a reasonably balanced day, I would say. In the Nifty space, you see Bharti Airtel, ONGC, Reliance. So energy was up, FMCG in the right corner was up. You had some auto stocks go up, but Tata Motors was completely smashed down 7.5%. Bajaj FinServ was down, but Bajaj Finance was up. State Bank, HDFC also gradually up. IT stocks slightly down. I think mixed bag today, but a decent mixed bag. In terms of Nifty Next 50, you had some public sector enterprises stocks go up, PFC, REC, IRFC, HAL. These were up. You had ABB smashed down today, -6%. Zomato, Indigo, Ambuja Cement continuously down. Adani Power, Adani Green also down. Adani Enterprise also not coming out with great results. So there is some pressure on the Adani group there. Other than that, DLF, Lodha were some of the gainers in the Nifty Next 50 space. Sectoral trends, public sector enterprise stocks, top leader for the day, 1.9%. Real estate, third day continuing, 1.8% up. Up the most in the last 1 week is real estate. Energy stocks 1.3. Pharma for a change up 1.2%. And the rest were a bit here or there. IT stocks losing the most today, -1.1%. So a mixed bag for the last 1 week. Some sectors are up, some sectors are down, but for the last 1 month and 3 months, most sectors are still down. IT remaining the only green over the last 3 months. In the public sector enterprise space, you can see that IRFC, BEL, Power Finance, Indian Oil, Power Grid, all these stocks were up, and basically day after is the budget, so there is expectation of uh, you know some announcements about public sector stocks, whether it is divestment or whether it is more investment or expansion. Those announcements are awaited in these stocks. So let's come to the topic of the day. Some advice can be dangerous, so be aware, beware. Uh, let's take a case study. Somebody who started out their career, let's say in 1997. I started in 1996, so you can say that, okay, a person of my age probably starting out in that year. First year return minus 16%, second year return CAGR basis 17%. By third year, that is reduced to 3%. By fifth year, it is down to minus 2%. And at the end of 7 years, CAGR is 6%. In an interest rate environment which was double digit at that point, so keeping your money in the bank used to get you near double digit returns. So after 7 years, this person may have had a opinion about the markets, that the markets are useless. I've invested for 7 years, and of course lump sum investment is what we are talking about. We're not talking about SIPs that would have improved the outcome, but lump sum investing. And 1997 was not a peak of the market or anything like that. It was just a normal year. So you have that kind of a pessimism based on your starting point, because you also put in lump sum money there, that I was better off putting my money in FD and stay away from the stocks, is what advice he or she may have given to others in 7 years. Now, exactly after 7 years, what has happened? So we started investing somewhere here in the middle of nowhere, and there was a rally that started for the next 5 years, which became the one of the biggest rallies of that decade. And after 7 years, if and this was a very tough period to go through. I mean, I've seen this period for almost 2 years. The market was as good as dead. So it was easy to just give up. The market is not doing anything for me. Let's give up. So somebody now another case study. Person B, he came into the market right here. Once person A was quitting, person B came in, and for him the first year return was 73%. After 2 years, CAGR was still 40%. 3 years CAGR was 41. 5-year CAGR was 53, and 7-year CAGR after the GFC crisis was still 18%. So that person, although hit by the last 2 years of underperformance, would still say that choose your stocks, uh, pick small caps. Market will continue to be euphoric from cycle to cycle. No need for asset allocation. Put everything into stock markets, and you'll get a fantastic returns much higher than the bank. That would have been the sort of expectation from that person. And what happened? 7 years post this period, market went flat. So the next phase of the market came after 2013-14, after the Modi era started. So this person was euphoric till this point, and then beyond that, the euphoria didn't last, and hence his advice to a lot of folks, maybe at the end of uh, 5 or 7 years, did not really materialize for those who listened to him, and they would have again gone back and to this situation where 7 years have gone by, nothing is happening. So in both cases there was a behavior of the past that determined what their influence on others was. So what they experienced over 5-7 years is what they told to their people who are getting influenced by them, and the exact opposite happened. So the first influencer was dejected. He forced people to go away from the market. Markets went up. The second influencer was gained money from the markets. He said everybody should come in. Markets went flat after that. So if we were to sort of now see what happened over 10 years for both of them, can you guess where they were in 10 years, both of them? Exactly 19% CAGR for both of them over 10 years. So the market will make you regret for not participating by exactly going up when you will give up. And the markets will make you regret for being euphoric, especially when you've actually had made some money. But in the end, you had to give up some to come back, reversion to mean. And then at that point of time, it'll give you lessons for the next many years that you need to, temper your expectations. So that is exactly what happens in the markets, that markets are cyclical. markets will do its thing, and rather cycles are compacting as we go from decade to decade. What used to take 10 years probably now takes much less time. But certainly, if we have now seen a euphoric, 4.5 years, a few years of some downtime is not bad actually. It will bring down expectations. It will bring down over ownership. It will bring down, maybe the froth in the market, and it will be ready for the next move whenever it happens. So, understanding and accepting the cyclicality of the markets, I think, is the biggest understanding of the market. If you want to double your money every other year, it won't happen in the market. It will stay lumpy. You stay with the market, it will give you that lumpy return once in a while, and then you have to stick around for the next lump to happen. So perspectives will change depending upon starting point, but this is lump sum investing I'm talking about. We've shown enough studies that for gradually bringing your money in the market on a SIP basis, even starting at the worst time is good enough. So as you know, it is said that what is the best time to start investing? It was yesterday, but if you have missed it, it is today. So at no point, if you are going to bring your capital in gradually, is any point a bad time to start. But if you are going to bring in your money on a lump sum basis, then yes, there will be a long wait sometimes before you hit that cruising CAGR. So for instance, let's go through all returns on Sensex from 1979, and you can see that in the initial years, for many years, maybe starting from 1981, you had poor returns over 3 years CAGR, but over 10 years, they all became 20%. 1985 was very poor, still 3 years. 86 was bad for 1 year. Then you had some great years if you started out in 97, 98, 99, 1990. And then, there was a decade of poor results. So 91 was Harshad Mehta peak. So if you started out at that peak, even in 10 years, you got only 6%. But then, as you went ahead in the 90s, you would find that the 10-year CAGR would have gradually started improving again. And even here, if you came in, at 2000, peak of 2000, which was a reasonable peak, again, you are seeing over 7 years, 10 years, you made good money. Then you go forward, you had some fantastic years where initial gains were really good, but post that, because of the GFC, you had to come back to nominal returns of double digits, even single digits. In 2006, if you started, in 10 years, you made only 7% return. But 2008, if you started at the peak of where you have where you were, you would have seen some fantastic returns. So again, there was a decade of sort of dullness, and you would have seen, more recently, you have seen a lot of initial years of gains, um, but then over a 3-year period, uh, if you started out 2021, you're still in double digits. If you started out 2020, you are still sitting at about 10% on 5-year CAGR. So Sensex probably is a bit muted also versus mid and small caps, etc. But the idea here is that the longer you stay in the market, the more sure you are of getting double-digit CAGR returns, and that's how it has been on the last 30, 40 years. So what to do is basically don't get influenced by, the last few years of performance. If somebody has made a lot of money in the last few years, not necessarily the same kind of money will get made in the next few years. Market has its own mechanism to, soften the euphoria. Asset allocation has to be ensured, market cap diversification. Some segments of the market, for instance, large caps have not really outperformed, whereas mid caps and small caps have done that. Strategies need to be adaptive and dynamic. So you need to shift maybe from one market cap to the other, also shift from one stock to the other, and never discontinue your SIPs, especially in your earlier, younger years. Keep a 7 to 10 year view, at least in my view, and just chug along. These few months of distress that come along are not reason enough to throw away your long term plan of making money from the market. The compounding needs time, and uh, if you break that uh, because of few months of distress, you basically lost the plot. Why do you think Warren Buffett is making maybe 90% plus of his money post age of 60 because he's compounding. He's not taking off money. Yes, you could go to cash, some part of his portfolio to cash and then deploy it. That's fine. But getting out of the market or giving up on the market, I think that is not a choice to be made in the equity market, especially a market like India, which has significant growth ahead of us. So let me know in the comments, have you been influenced by people around you, and how you're dealing with that. Do like and share this video if you liked it, and do subscribe to the channel. Thanks. Bye.